What's up, everybody? This is Sungko, the Korean bro. Today is 2023, July 25th. Uh, let's look at market, okay? Hmm. Okay, let's see. Hmm. Okay, can movie theater stocks keep the Barbenheimer rally going? Dividends. You don't have to pick a winner in the dividend stocks. Here's why. Okay. Nvidia stock investors should love what Elon Musk said in Tesla's earnings call about AI. These two stocks are trying to lift the Doge Tuesday. Is John Johnson Johnson stock buy now? Two no-brainer reasons to claim Social Security benefit at age 62. Mm, okay, first is Johnson Johnson stock a buy now? Shares of Johnson Johnson marched higher after the company reported second quarter earnings last week. In addition to results that bit Wall Street expectations, Johnson Johnson raised its earnings outlook. Johnson & Johnson was able to report overall growth in the quarter, but some of its top-selling products are hmm, quarter earnings report that was far more positive than they were expecting. Of course, one good quarter report on its own isn't a great reason to buy J&J or any business. Let's take a closer look at J&J's recent performance in light of the major shakeup that occurred earlier this year to see if the stock is a good buy now. A reputable strategy. Reasons to remain cautious. Despite bounding higher after latest earnings call, shares of J&J are currently trading at 15.8 times earnings expectations. This is a very reasonable price to pay for a business that expects to grow earnings per share by 6% this year at the midpoint of management's guided range. Buying some shares of J&G now, talking them away for a long run gives investors a decent chance to outperform over time. This probably wouldn't be the best performing as in your portfolio, but it's still a smart buy because the odds of losing money over the long run are extremely slim. Verizon Communications, CVS Health, Alphabet. Let's take a closer look at Alphabet. Okay, Alphabet. Mm, the third magnificent stock that's being added hand over fist to Warren Buffett's secret portfolio is none other than FANG stock Alphabet. Google, the parent company of search engine Google and streaming platform YouTube. After opening a 17,100 share stake in Alphabet's Class A shares in the December ended quarter, New England Asset Management bought another 13,300 shares in the first quarter. Hmm. The biggest hurdle Alphabet has encountered is advertising weakness. with a number of recessionary indicators and metrics suggesting that economic weakness is on the horizon. Advertisers have been quick to pare back their budgets over the past year. Alphabet generates the lion's share of its revenue from advertising. But advertising is a two-sided coin. Though downturns are an inevitable part of the economic cycle, periods of expansion last substantially longer than recessions. Downturns are an inevitable part of economic cycle. Periods of expansion last substantially longer than recessions. For ad-driven businesses like Alphabet, it means possessing strong ad pricing power more often than not. Hmm. For the moment, Google remains Alphabet's cash cow. Hmm. According to data from Global Stats, Google accounts for nearly 93% of worldwide internet search share. Wait, hold on. So Alphabet is the parent company of the search engine Google and streaming platform YouTube, which means I own YouTube and Google, right? Alphabet, the parent company of search engine. Hmm. Operating as a practical monopoly makes it a logical go-to for business wanting to reach a broad or targeted audience. But it's the company's ancillary operating segments that are expected to propel its share price higher. YouTube is second most visited social site on the planet, while Google Cloud was responsible for 9% of global cloud infrastructure service spending the first quarter per Canalys. Wait, hold on. Let's repeat this one more time. Okay, since it seems really important. Okay. According to data from Global Stats, Google accounts for nearly 93% of worldwide internet search share. Operating as a practical monopoly makes it a logical go-to for business wanting to reach a broad or targeted audience. Hmm. But it's the company's ancillary operating segments that are expected to propel its share price higher. YouTube is second most visited social site on the planet, while Google Cloud was responsible for 9% of global cloud infrastructure service spending in the first quarter per Canalys. Google Cloud is a particularly interesting segment given that it generates substantially higher margins than advertising. And it produced its first ever operating profit in the first quarter. Despite bouncing back strongly from its 2022 bear market low, Alphabet still looks historically cheap relative to its cash flow generating potential. So the reason Alphabet uh, can keep growing is because uh, it has both YouTube and Google. Uh, the Google search engine accounts for approximately 93%. Uh, so if you run business, Google is like the destination that you want to use. Hmm. And at the same time, YouTube is like the second largest SNS that people use. So its dominance, because of its dominance, YouTube and Google, Alphabet can grow dramatically. And plus, um, Google Cloud accounts for 9%, responsible for 9% of global cloud infrastructure service. So, given all that information, it's a sure buy, and that's the reason why it's being added to um, Buffett portfolio. Okay. Offshore holdings, upstarts. One unstoppable stock down 85%. Shares of Upstart have traded as high as $41, as low as $12 over the last 3 years. Investors were excited by the company's AI-driven lending models in 2021 before concerns set in last year. But Upstart's models and its business appears to be holding up well, leading to a surge in its stock in 2023. Shares of Upstart have surged some 350% in 2023, but there could be more upside ahead. Shares of Upstart are sitting on a whopping gain of 353% in 2023, yet they are still trading 85% below their all-time high. How is it possible? The stock listed publicly in 2020 at $20, surged as high as $41 in 2021, and it collapsed to a low around $12 late last year. Therefore, its 2023 returns has come off an extremely low base relative to where the stock has traded previously. You might be wondering what triggered that roller coaster ride in the span of just 3 years. I'll tell you and explain why Upstart stock might be a buy now. Upstart is disrupting the lending business. Upstart is an artificial intelligence software company focused on helping banks and financial institutions measure the credit worthiness of potential borrowers more accurately. It's no easy task. The company's up against the fair is Safico credit scoring system, which has been entrenched in the banking industry for more than 3 decades. Unhooking lenders from the comfort of what they know is a real challenge. But Upstart's proposition is attractive. Its AI models can access 1,600 different data points on a borrower so quickly that 84% of approvals are instant and fully automated with no human intervention. By comparison, FICO looks at just 5 core data points. It can take a human accessor days or even weeks to come to an approval decision. At the height of the pandemic during 2020 and 2021, interest rates were adjusted to record lows and the US government flooded the economy with stimulus money. Consumers took full advantage and went on a borrowing binge. Upstart processed a record number of loan originations and its revenue more than tripled year over in 2021. The stock price followed along and hit an all-time high of $41. But the tide turned in 2022 and those conditions reversed. Surging inflation forced the Federal Reserve to embark on the most aggressive campaign to hike interest rates in its history. Investors grew concerned that Upstart's AI models hadn't been battle tested in such a harsh economic environment. All the while, consumer demand for credit plunged, which caused Upstart's revenue growth to flatten out. If triggered a collapse in the stock price, sending shares as low as $12, but investors weren't the only ones panicking. Upstart's funding source dried up, forcing the company to absorb some loans on its own balance sheet that added a whole new dimension of risk to the business. But Upstart's almost out of the woods. Okay, so I get it. So disrupting the landing business. Originally, the ecosystem has been used for 3 decades. And now here comes AI. Um, this AI um, mm, test borrowers according to multiple points in a couple of seconds. Um, if FICO system was used, it would have taken like long days or so. But then if AI is used, then it could measure potential borrower in a second or so, and it's more even accurate. So it'd be much better if AI is used in this case, right? Uh, so Upstart, its price went up all the way to $41 at a certain point, uh, because a lot of borrowers headed to bank uh, because of low interest rates. But then, as government decided to hike interest rate at certain point because of Corona and shit, uh, like at some point, there were a point where even this company had a hard time let borrower uh, let person borrow money, and at the end, its price went all the way down to the level. What is it, like $20 or so? Yeah. Mm, yeah. But Offshore is almost out of the woods. The company embarked on a mission to prove its AI models were holding up just fine. It has published a series of data points over the past year showing they are still significantly more accurate than traditional methods of assessment. Yes. It's published a series of data points over the past year showing they are still significantly more accurate than traditional methods of assessment. Wow, 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 wow. In summary, 53% fewer offshore loans and in default compared to loans assessed by the big banks. That means offshore AI can write 173% more loans at the exact same default rate. Those figures are likely to improve over time because the company continues to train its models on data generated from 90,000 new loan repayments each day. AI algorithms are like living neural networks. When those borrowers either make their repayment or default, option models learn and adjust accordingly as risks evolve. That has profound social impacts. Two officers algorithm approves 43% more. Uh, algorithm approves 43% more black borrowers and 46% more Hispanic borrowers than traditional methods of assessment. Plus, it approves them at a significantly lower interest rate. Not only is that great for those consumers, but also creates an opportunity for officers' funding partners to access new markets that previously fell through the cracks. This has culminated in a series of wins for the company in 2023. First, it had 99 total funding partners in the first quarter, which was almost double the number it had a year ago. Some of those partners committed more than $2 billion in funding, which will ensure Offshore won't have to put its balance sheet at risk again. Second, in May, an investment fund called Cashlick agreed to buy $4 billion worth of offshore consumer loans in a massive vote of confidence. So buying stock after it plunged 85% from its all-time highs is never easy. But Offshore has stabilized its business and is in great position to capitalize when consumers' demand for credit eventually reignites. On that note, the company is eyeing a series of lucrative long-term opportunities. Right now, it operates in the personal loan or auto loan segment, which sees about $946 billion in originations each year. For context, Upstart has originated only $32 billion loans in its history, so it hasn't even scratched the surface of those addressable markets. But it gets better. Upstart has highlighted a $644 billion annual opportunity in small business loans and a whopping $2.7 trillion annual opportunity in the mortgage market. The company hasn't entered either segment, but doing so would quadruple its current addressable opportunity. Wall Street and analysts expect Upstart to deliver $549 million in revenue in 2023, which will be a 34% drop compared to 2022. But the company's recent growth struggles might end there because the Street predicts revenue will bounce back 41% to $773 million in 2024. Considering Upstart's lending models have just proved their durability in one of the worst interest rate shocks in history, the company could be poised for growth long into the future. That makes the 85% discount in its stock price an attractive risk reward proposition. Nvidia made a lot of investors millionaires over the past 10 years. Most of that growth was driven by the expansion of its gaming and data center businesses. Okay, take a closer look at Nvidia. Most of that growth was driven by the expansion of its gaming and data center businesses. Hmm. The growth of the AI market could drive its stock even higher, but its high valuations could limit its gains. The AI market could drive its stock even higher, but its high valuation could limit its gains. The chip maker could struggle to replicate massive gains from the past decade. Over the past 10 years, Nvidia stock skyrocketed 13,120%. The gain would have turned a $10,000 investment into more than $1.3 million. The same investment in an S&P 500 index fund would only have grown to $27,000. Compound annual growth rate of 20% from a $4.28 billion to $26.97 billion. As its adjusted net income grew at a CAGR of 28% from a $728 million to the past 12 months alone, Nvidia stock surged roughly 210% as the expansion of the AI market fueled more purchases of its high-end data center GPUs, process machine learning, and AI tasks. Most of the top generative AI platforms, including OpenAI, ChatGPT, and DALI, are currently powered by NVIDIA GPUs. Okay, I get it. So once again, the past 12 months alone, Nvidia stock soared roughly 210% as the expansion of the AI market fueled more purchases of its high-end data center GPUs, process machine learning, and AI tasks. Most of the top generated AI platforms, including OpenAI's ChatGPT and DALI, are currently powered by NVIDIA's GPUs. The bulls believe the growth of the end market, along with Nvidia's continued dominance of high-end gaming GPUs, will drive its stock even higher over the long term. But can you generate even more millionaire-making gains for new investors? You know, can Nvidia turn $10,000 into 100,000 again? Nvidia history run over the past decade was driven by its accelerating growth and its expanding valuations. On July 19, 2013, Nvidia was only trading at a split adjusted price of $3.56 per share with an enterprise value of $4.5 billion. That was only 14 times the adjusted EPS it would generate in fiscal 2014 and less than one times that year's total revenue. It was engaged in a margin crushing price war with AMD in the gaming GPU market, losing the smartphone chip market to Qualcomm. Nvidia will need to grow its top line at a CAGR of 20% to achieve that 9,900% gain, which will boost its annual revenue from a $27 billion in fiscal 2023 to $2.7 trillion in fiscal 2048. If the AI hype dies down or the market crash, I believe Nvidia's valuations could easily be halved to a more reasonable 31 times for earnings and 13 times for sales. At those lower valuations, it could take at least twice as long or more than half a century to turn a $10,000 investment into $1 million, even if it keeps growing at a CAGR of over 20%. The simple math suggests that Nvidia won't repeat its millionaire making run over the past decade anytime soon. And expect its revenue to continue growing at a CAGR of 37% between fiscal 2023 and fiscal as AI market expands. But those high expectations could set it up for a steep drop the moment it drops its ball. NVIDIA established the first mover's advantage in the high-end data center GPU market, but it could face tougher competition from other chip makers like AMD and Intel, as well as smaller chip designers like Graphcore in the near future. Tech giants like Microsoft, Alphabet's Google, Meta platforms have also been developing their own AI accelerator chips to reduce or eliminate their dependence on NVIDIA. I'm gonna. Okay, now let's head to Shopify. Okay, Shopify is the um, main company that I write my blog about, And so far, I've been doing a lot of research, and of course, I'll publish it tomorrow. But uh, we'll see how it goes. Okay. Mm. Shopify. Okay, let's see. Okay, bull market could be here. Three reasons to buy Shopify stock. Sales trends were encouraging last quarter. Watch for a big improvement in earnings and cash flow following the sale of Shopify's logistics business. Hmm. The e-commerce specialist is on the fast track toward profitability, with stock indexes up sharply from their lows. Many investors believe the next bull market may have already started. Wall Street is excited by the diminishing prospects of a hard recession this year, and some growth stocks have responded by soaring through the first half of 2023. Shopify fits into that category. The e-commerce platform stock has roughly doubled since early January, compared to a 35% spike in the Nasdaq Composite Index. Hmm. But investors could still see long-term returns from buying this market-beating stock. Now, let's take a look at a few reasons why. Okay. Commerce everywhere. Like all of its peers, Shopify endured a growth hangover in the second half of 2022, but demand trends have stabilized and appear to be on the upswing. Gross merchandise volumes in quarter first was up 18% on a constant currency basis, compared to 16% for full year 2022. Overall revenue jumped 27%. Gross merchandise volume. High demand for subscription services and payment processing. Mm. Thanks to high demand for subscription services and payment processing. The business is winning in both the e-commerce and physical retailing channels too, implying there's a long runway for growth ahead. The business is winning in both the e-commerce and the physical retailing channels too, implying there is a long runway for growth ahead. Shopify can build on its roughly 10% market share in the US. For example, while using its point of sale system to account for more in-person transactions. Shopify's strong first quarter results demonstrate once again that we're the go-to solution powering business of all sizes. On every surface where they sell, Shopify President Harley Frankston said in an early May press release. Hmm. Rising margins. Wall Street is excited about Shopify's potential to boost profit margins over time. Much of that rebound will be driven by factors like the end to the pandemic related growth hangover and the aggressive cost cuts the management has been rolling out over the last few quarters. The bulk of these expense reductions will come from the sale of its logistics business to Flexport, a move that should make Shopify a more efficient business overall. The bulk of these expense reductions, the logistics industry is extremely capital intensive compared to the company's core marketplace platform. After all, it was a complex distraction from the main business too, so splitting it out will give management more flexibility to prioritize higher return investments. However, their profitability spike has yet to show up in the company's results. But investors should watch the trend in operating margin over the next year or so for signs the strategic shift is working. The price is right. As you might expect, you will have to pay a high premium to own an industry leading stock like Shopify. The company is valued at nearly 15 times sales today, up from a less than 8 times sales earlier this year. The value is still far below the 60 times sales investors were paying for the stock at its peak. Sure, the company is currently unprofitable and its growth rates have slowed as e-commerce demand trends reverted to more normal patterns. But the business features many of the key ingredients that apply to most successful growth stocks. Shopify had a large market share, an industry that's set to expand for many years. It has several growth avenues to target, including a bigger portfolio of merchant services. There's also good chance that profitability will be much higher in 5 years than it is today, considering this factor. The stock looks attractive even after its rally over the last several months. Okay, this is it today, and I'm gonna see you tomorrow. Okay, bye bye.